Hello, clients and friends. This is Craig Llewellyn with U.S. Investors International, and it's my pleasure to present to you our second quarter economic review and give you an update as we move through here on the third quarter. At our firm, we partner with clients and believe an educated client is our best client. While we always try our best to help you with your finances, we believe that knowledge is power. And one of our missions is to share any knowledge with clients to help them make informed decisions. After a strong first quarter of 2024, equity markets began the second quarter with a rough start, largely attributed to the Federal Reserve's decision not to reduce interest rates because we were still experiencing stubbornly higher than their desired inflation rates. As the quarter progressed, strong performance from companies tied to artificial intelligence and a more favorable outlook on inflation numbers changed that perspective. By the quarter's end, investors saw multiple all-time high days and many records were set for equities. The broad-based S&P 500 returned nearly 4% for the second quarter and closed at 5,460.48. The Dow Jones Industrial Average, which does not have as much of a tech influence, made new highs in the quarter but finished down about 1.7%. Following the strongest first quarter since the pre-pandemic days of 2019, the equity markets continued to build on their positive momentum in the second quarter, and the S&P 500 is up over 14% for the year through the second quarter. The Dow is up 4% year to date. This ongoing bull run is a testament to the market's resilience. So starting the quarter, inflation was still a concern for investors. The Fed closely monitors the Consumer Price Index, the CPI, which is a broad measure of goods and services costs, as one of the indicators for interest rate adjustments. The good news is that inflation showed signs of slowing down in April, May, and June, and as well as July. In May, the Consumer Price Index was 3.3%. In June, the CPI was 3.0. Based on the June results, many economists feel that the Fed may have done enough to keep current inflation down from the challenging rates of the last few years. And we know in July, inflation came down a bit more. And recently, in the last few days, more indicators are showing this economy is slowing further. So in the second quarter, the Fed did not raise the federal funds rate. And so for the seventh session in a row at that point, they kept the target rate of 5.25 to 5.5. They did that again just recently. The Fed meets 8 times a year, and we've begun the meetings in the second half. There's a few more meetings left, and there's with the pressure of the data, the negative data coming in on the economy. It's hard to say what the Feds are due, but I feel more strongly now that there'll be at least a 25 basis point cut in September, and I think there's a debate whether it should be stronger than that. So the news of improved inflation numbers and the Fed's continued commitment to cut interest rates in 2024, it's definitely helped the bond markets in the second quarter in terms of price increases. Remember, bond prices and yields go against each other. As prices go up, yields go down, and vice versa. So in the second quarter, we still had an inverted yield curve, meaning that short-term bond yields were more than longer-term bonds. Since the second quarter, we've seen that flatten out a bit, and in fact, giving the strong indication from the Feds that they may lower rates in September. We're seeing that the short-term CDs that we've been doing, where we've been getting well over 5% on them, now they're well under 5%. They're 4.5 to 5 now. So it's really interesting. As of June 28th, 5-year Treasury notes yielded 4.36%, 10-year notes yielded 4.36%, 20-year notes yielded 4.61%, and 30-year notes reached 4.51%. Today, I can tell you these numbers are lower. The inverted yield curve has been long running, longest one I think I've ever seen, beginning in July 2022, nearly 7 consecutive quarters. While economists typically see this as a warning sign of a potential recession or poor market performance in the near future, we have yet to see this come to fruition. Right now, investors can receive some interest on fixed income holdings. We will continue to monitor closely how the Fed's movements and interest rates are affecting bond yields. With the Fed's anticipating lowering interest rates this year, the opportunity to get lower risk, higher yielding bonds will continue to narrow, as we've begun to see. So we have been all year taking profits out of the large growth area where those tech stocks have been, and we've been moving more towards the money markets and the short-term bond funds. And now we're moving more to the intermediates to take advantage of what looks like to be some lower yields as we move forward from the Feds. But safety comes with a cost. And even though interest rates have risen, many major banks are still offering low interest rates to savers. It's an interesting time. Really the first time I've seen the banks, well, actually it's the second time I've seen the banks not keep up with rates. It's fascinating. According to Barron's, the average bank money market rate on July 1st, 2024 was only 0.56, and the average 12-month CD rate was 2.05%. While they have increased in the last 12 months, many savers are still seeing lower returns. Now, I can tell you since the second quarter, these numbers have actually gotten a little worse. So it's getting harder to find the higher rates. Some of the banks were offering with some gimmicks, some higher rates, but we've still been able to beat the banks with CDs, with the brokerage CDs. The global economy experienced continued uncertainty during the second quarter. Global tensions persisted, including conflicts in the Middle East and the ongoing Russia-Ukraine war. A lot of different developments happening there. It's fascinating. And also the presidential election year. We knew that this was going to be an entertainment year, and it certainly hasn't disappointed us in that. Here you see it was Biden and Trump. Now we know it's Kamala Harris and Trump. It's important that on these elections, in terms of the market, long term, it just doesn't matter who the president is. And we've got charts going clear back to all these different presidents. Markets are a different thing than elections. And remember, we're investing in companies, not in politicians. Thank goodness. So clearly elections create headlines. And also there's some key races for the Senate and House of Representatives. The outcomes of these elections could impact policy and tax law, leaving more uncertainty. And that's what I'm more interested in, is which way is Congress going? Because that's long-term. It's policies out of Congress that impact our money. While earnings in the economy are the main drivers of financial markets, one of our roles is to keep close watch on how these events may impact the equity markets. And between now and the election, I think there's going to continue to be a lot more entertainment, and I suspect a lot more volatility in the market like we've been seeing. And I've been saying that since June in the meetings, May, June, that historically we get volatile markets just before any election with the uncertainty. So we're expecting more. But we are still currently experiencing a bull market. And the question is, how long can it last? It certainly lasted longer than I thought it would have. While the U.S. economy continues showing signs of strength and resilience, positive inflation numbers will be key to the Fed being confident enough to start cutting rates. Should the economy maintain a healthy status, we may see the soft landing the Feds have aimed for. However, should the economy experience a slowdown, recession concerns could increase. And it's important to remember, too, that geopolitical events could play an impact here, and it could change overnight. So having more cash earning the higher rates in money markets and the CDs, having a little higher cash component here, having more into the short and intermediate bonds right now, not only will position us for a downturn in the interest rates by the Feds, but anything that upsets our economy and forces the Feds to move faster, I think we're in a pretty good position with a lot of these portfolios. And we will experience an overdue pullback. We saw back in a few weeks ago, we saw a correction in the markets. The Dow was close, didn't quite get to correction is considered 10% or more. The NASDAQ did get there. They were a little more than that. The Dow was close. So we had a correction. But for the first half of 2024, investors did not see any large market pullbacks. But it's just a reminder, they do happen. We just saw it again and again. I think we'll continue to see this volatility. We believe that speculation is not a good strategy. A lot of people speculate. When you see market highs, you get a lot of speculation. People feel like it's the fear of missing out. So instead, staying vigilant and focused on your own well-devised long-term personal situation is a much wiser investment strategy. There's been some talk of stagflation is emerging in the news. It has been over the last few weeks. Stagflation is the nickname for an economic cycle wherein we experience low economic growth, a high unemployment rate, and increased inflation. This can be a precarious situation to fix for policymakers, as attempting to correct one factor could aggravate another. For the record, though, the Federal Chair, Jerome Powell, is confident that we're not in a state of stagflation, stating that he sees neither the stag nor the inflation, and that he didn't really understand where talk of stagnation scenario is coming from. It's important to consider equity investments from a long-term perspective always. It's a good time to review your investments. We've been doing that all year with you. Again, many of you we've had some good profits late last year into this year, and we've just been rebalancing, not getting out of things. We want to participate in this market run, especially in the tech. Remember, it's been a very narrow market in the tech stocks, not the healthiest of markets, but it's been some good returns there. But it won't last forever. We know that. And so taking profits out and coming to more of the value sector, including the bonds, has been prudent. I think it will pay off here as we move towards the end of the year. So we believe in this proactive preparation and providing you with resilient financial strategies. So key takeaways, a recap of what we talked about here. Equity markets closed out the second quarter with solid results. The federal fund rates still remain at 5.25 to 5.5, though we think that will change in September. At this point, we're feeling more confident on that. An inverted yield curve remains. That means short-term rates more attractive than long-term rates, though that is changing, has been flattening out. And you see that on those short-term CD rates. We're seeing them, they're now under 5%. The Fed is no longer, this is through the end of second quarter, the Fed was no longer anticipating 3 rate cuts as previously anticipated. I'm not sure that may not happen still. So B-rate I'm pretty confident we'll get one in September. We'll see though. If the economy picks up steam of slowing down, we could see that 2 or 3 still. I think the jury's still out on that. Both the economy and equity markets ended the second quarter strong. They remain strong through the correction. They bounced right back. But again, volatility, I think we're going to continue to see this, especially as we get into the fall months now. We get out of the summer, people come back to work, vacations are done, kids are back to school. The election, people will really start tuning into the election. So the next couple of months, I don't think there's any shoe-in on who's going to win this election at this point. But I think there's plenty of things that will create volatility in the market. And again, that geopolitical event, a lot of things happening out there. I wouldn't be surprised to see something happen there too. Staying the course and maintaining the consistency of a well-devised, long-term focused plan has historically served us well for my 3 decades of doing this, my 4 decades of investing, and history shows even further than that. Be well prepared. Recent history has shown us that anything can happen. So once again, caution should still be the principal notion for investors. And looking at Warren Buffett, it's interesting is he's at an all-time high record in cash here. So he's been taking profits. He sold half his Apple, sold a bunch of his Bank of America. And he was already a record before he did that in cash. So that's what we've been doing, taking profits, moving more to a cash position where we can earn something for the first time in a long time. We're earning it, moving more to the bond sector. Warren Buffett is a bigger holder of U.S. treasuries than the federal government today. So I think we're on target here. This won't last forever. It's been 15 years almost since we've seen our last recession, normal recession. That's not normal. What we've seen the Feds do with interest rates over the last 15 years have not been normal. It's the longest period of easy money we've ever seen. And it's good on one hand, but it causes a lot of problems on another. And we're seeing those today. So as we move into next year through the election, election years tend to be good. And I think this one will end up just having the election over. I think I've talked to different people in different businesses, and I think that's just getting the election over with will get people to quit worrying and get back to it. So great time to be getting out of short-term debt, but talking to everybody about that, getting rid of credit card debt, You can get your cars paid off. You know, homes, be careful on your homes. A lot of people refinance down under 3%. I just talked to somebody yesterday, wanting to pay off their mortgage at 2.625%, and they've got 12 years left on that mortgage. Don't pay that off. That, you know, let it go. We'll never see, I don't know if we'll ever see rates like that again. That's free money when you look at the dividend yield on the S&P 500. So be careful with in terms of paying off mortgages, but definitely debt, credit card debt, any debt that, you know, you can't deduct from your taxes, any debt that that's not also an investment. I call it bad debt, credit card debt, these consolidated loans debts and all that. Get out of those now while things are strong. Increase your emergency cash positions. This is the time you do it when things are good. So you want to be ready for that next downturn. So we're grateful, always grateful for our clients and value the opportunity to accompany you on your financial journey. It's been a ride for me, I know, over the years. We retired many of you. It's really fun. It's just awesome to enjoy that ride with you. And our goal is to assist more people just like you. The greatest compliment we can receive is a referral. Many of our most satisfied clients were introduced to us by existing clients. If you know of someone who could benefit from our services, please consider sharing this video or adding a friend to our mailing list. If you do that, we get them invited to the workshops. It's a really easy way for them to see who we are and to see the information you're getting. And I think we try to give out prudent information, and we try to make it timely. We would be honored if you could provide us with their contact information so that we can add them to our distribution list. We don't chase them. We don't sell them anything. We're just giving them the information you're giving. And it enables them to receive our newsletters and inviting them to watch or attend our presentations. This is how we grow. We're just giving out information. If somebody's interested in talking to us more, great. So once again, thank you for your trust in us. One of our main objectives is to keep our clients informed, and we appreciate you taking the time to watch this update. Please feel free to call us if you have any questions. And I hope you have a great rest of the summer, and we'll see you all soon.